Okay, in these slides, we're going to talk a little bit about the banking system and some basics of how the banking system works. Quote here from a Rothschild who wrote, banking consists essentially of taking money from point A, where it is, to point B, where it's needed. By the time we finish these slides, hopefully you'll agree with that comment and understand what it means. So we'll begin with imagining there's two types of agents or two types of individuals and firms. Surplus agents who have got more money than they need or want to spend, and deficit agents who need more than they currently have to spend. You can think of an easier way of thinking of them as savers and borrowers. Banks perform the role of intermediating, or they perform the role of the middleman, which is they take money from the surplus units or the savers and they persuade them to give them their money by offering to pay them an interest rate, and they then lend some of that money out to the deficit units, and they charge the deficit units or the borrowers a higher interest rate than they pay the savers. And banks make money by charging a higher interest rate to the borrowers than they pay to the savers. We can think of banks as being organizations that collect and issue financial claims. If you borrow from a bank, you get money and you give the bank a claim, and the claim is like a promise that you're going to pay the bank back the amount you've borrowed in the future with interest. And if you're a lender, like the bank is, it gives out money, it issues money, and it receives a claim from the borrower, which again is that promise that it will pay back. And these claims are going to be assets to the lender and liabilities to the borrower. So the asset will be the loan that the bank has made. The asset's a loan to the bank and a liability to the borrower. So if you get a mortgage from a bank, then you've got a liability because you have to pay back the bank the amount you borrowed, whereas the bank's got a right to economic benefits in the future, which is an asset. So when banks make loans, they have assets, which are rights to economic benefits at future time. Some people would say, why do we need banks in the first place? Can't we just cut them out? Can't households just give money to firms and the firms give claims back to households promising to repay them? Why do we need banks to step in and be the middlemen? Well, some problems with doing this, which is savers each have got quite a small amount of money, and borrowers sometimes want to borrow quite a lot. Savers want money straight away, where they can put the money in the bank and get it straight out, whereas borrowers want to tie up that money in a long-term project. Savers usually want a guarantee they're going to get the money paid back, whereas borrowers sometimes are going to invest in risky activities. So by having a bank as the middle agent here, where households can save money in a bank, banks can then screen out the different financial claims and make loans to companies and individuals that seem like they're going to repay. They can solve the problem that can arise with direct lending. They can bring lots of money together from lots of different smaller savers. They can make large loans, which are long-term, that keep some money aside to use to pay out if people need their money back. And they can also develop expertise at screening out and shuffling around who's going to be a good candidate to lend to and who's going to not be so good to lend to. So they can eventually lend to good, profitable borrowers who are going to pay back and who they can develop trusting relationships with. These are things that individual lenders on their own won't be able to do usually. So banks don't do this for the good of their health. They do this activity to try and make a profit. And they do this by charging a higher interest rate to the borrowers than they pay to savers. So if we take this example here, we assume a bank manages to collect £100 million from savers. It promises to pay them 1% of their savings. It keeps aside £10 million in reserve. So if anybody wants their money back immediately, then they've got enough money to pay out to people if they need money straight away. But with that 90 million, then makes loans with all those that 90 million pounds. So it might loan to companies that want to set up, might loan to people who want to make a loan for able to buy a house or to finance consumption. So they've got that £90 million, and let's say they charge 10% for all those loans that they've made. So the bank's income will be 10% of that 90 million, which is 9 million. The cost will be the 1% that it pays to the savers, which will be £1 million, 1% of 100 million. And the profit will be the income of 9 million, take away the cost of 1 million, which gives you a happy profit of £8 million. Seems so easy, but the fact is, banking is risky. Two big types of risks: liquidity risk and asset risk. Liquidity risk is the risk that the bank runs out of cash, and asset risk is the risk that the bank invests in assets that don't repay. In other words, they make a bunch of loans to certain companies or certain areas of the economy that are ultimately unable to repay them. So if we think of the bank here, it's got two ways it can get money in. It can get money in from new depositors. So new depositors, meaning new savers, can save in the bank with the expectation they'll get a little bit of interest. And they also get money in from repayments from loans. So when it's made loans to people, it's got these assets. When the assets start repaying, that's another way banks can get money in. And it pays money out when people withdraw money from the bank, and it also pays money out when it makes new loans. So that's two sources of money coming in, and two ways money can come out from a bank. Now, let's assume that something happens, and because something's happened, the bank doesn't get money back from people that it's borrowed money to. And if it's a fairly big chunk that it's lent out, it's made a big bet on, say, a bunch of railway companies in America, and those railway companies all go bust. Or if it's made a big bet on, say, the housing market in Canada, and suddenly it's lent to lots of people in Canada, and there's a recession in Canada and lots of people aren't able to pay their mortgage, then the bank gets less loan payments in. If this happens in a fairly big scale, as it did in 2007 and 2008, then eventually people who have saved in the bank, who have basically lent the bank money, they become a little bit nervous, and eventually people start withdrawing their money from the bank because they think, if I leave my money in this bank, the bank's going to go bust, and I'm not going to get my savings back. When this happens in a mass scale, when lots of people try to withdraw their deposits at the same time, it's called a bank run. And if a bank run's underway, not only are people taking money out, but less people are paying money in. And when all these conditions come together, nobody's paying money into the bank's not receiving any income from the assets it has, and people are withdrawing money, then the bank's basically just going to run out of money. And a consequence of that is it won't be able to make any new loans because it doesn't actually have any cash sitting around there to make loans with. That's bad for the bank, which is going to go under, but it's also bad for society because there can be some profitable companies who the bank's not able to give an overdraft to, which may then not be able to continue in business. Or there can be new companies that can come along who have got profitable ideas, who could set up good companies that can add good value to the society, but they're not able to get loans because the banks just run out of money. 2007, this happened in the UK, so this isn't just pure theory. In 2007, Northern Rock experienced the first bank run in Britain since 1866, when a queue of people who thought Northern Rock was going to go bust all queued up to get their money out. And when some people queue to get their money out, other people think, well, Northern Rock's going to run out of money because all these people are taking money out of the bank. So more people queue up to get money out of the bank, and before you know it, there's a huge queue around the block of everybody trying to get their money out at the same time. Northern Rock happened in the late 2007, September 2007. Just that same year, Royal Bank of Scotland had posted profits of £10 billion. It had assets of over £2.5 trillion, which again means it had made loans to the value of £2.5 trillion. That made it the biggest bank in the planet. In the 2006 year before, the chief executive, Fred Goodwin, this chap here, was given a CEO, sorry, he was given a knighthood, a KGB for his services to banking. So he became Sir Fred Goodwin. But all good things, what goes up sometimes comes down, sometimes good things come to an end. Major problems were revealed with the bank in 2007, and by 2008, it had posted profits, it posted losses of £24.1 billion, and it needed to receive a bailout from the government of £13 billion to stay afloat. This is its share price here. So in 2007, it reaches this massive high, early 2007, of over £7 a share. Then the share price goes down. This is the share price from 2005 up until just after 2012. The share price goes all the way up here to £7. But with £7 in first quarter of 2007, then by 2009, it had gone all the way down to less than 20 pence. So huge collapse of the bank. It wasn't just the Royal Bank of Scotland that failed. Almost all banks in the UK failed at the same time. And without government intervention, probably almost all of them would have failed, if not all of them. It didn't just happen in the United Kingdom, also happened in the United States as well. Maybe the most famous case was the collapse of Lehman Brothers in 2008, which was a big investment bank, which the government initially allowed to fail, and it caused major shockwaves across financial markets and across the UK and the US economy. Now, sometimes in business, you should say, just let them fail. They pay their money, they take their chances. If someone goes into, say, a roll business where they set up a roll shop and it doesn't work out, then you say, well, just let them fail. That's kind of how markets work. If it worked out, you can make a lot of money. If it didn't, no, that's business, that's life. But if we just allow banks to fail, it can have much more significant consequences on the rest of us. First of all, if a bank just fails and nothing's done, then lots of savers might lose all of their savings. If the bank's not around, it can't make loans, which means companies can't receive investment. It means there'll be less tax revenue for the government, not just from the bank being unable to pay taxes, but from businesses being unable to continue to function because they're not receiving funding from the banks, which means that they're able to generate less profits, which means they can hire less people, all of which means less tax revenue for the government. Banks also provide something called the payment services for the economy, which means they help facilitate payments. That's both online through online banking, when you can transfer money from one place to another, or through when you're in the supermarket and you pay with your credit card. So when banks fail, they're unable to provide payment services. And in 2008, we were just about 2 hours away from the payment service failing, which would mean you could go to the supermarket to pay money with your card and it wouldn't work because the bank behind the payment service was no longer in business. So when banks fail, lots of other companies can go out of business, which means less spending, more unemployment, and more people default on loans, which means more problem for banks, less loans, less investment, more unemployment. This system here of a banking crisis happened in the Great Depression in the 1930s. This is the unemployment rate in the United States from 1890 up until 2010. And we see the unemployment rate jumps here way up to over 20%. Some estimates it put it higher than that, over 25%. Obviously, there was lots of causes of the Great Depression, but maybe the biggest one was the failure of the US banking system and the fact that nobody stepped in to try and save the system. They just let the system fail, and it caused a major depression. We learned one of the lessons from the Great Depression by 2008, which was don't just let the system fail. Step in and try and save the system, not because we care about the bank or the bankers, but because we care about the economy at large. We care about companies that are not financial companies, and not just them, but we care about their employees. And without the support of the banking system, they will probably all be harmed and hurt by the failure of the banking system. So, massive intervention in 2008 to try and stave off the crisis. £325 billion was injected into the financial system. Royal Bank of Scotland alone ultimately received money worth, they received capital injections worth over £40 billion. With £40 billion, instead of spending it in healthcare or education or schools or roads or police, the money was spent by the government investing in a stake in the Royal Bank of Scotland to try and keep the bank afloat, to try and make sure it had enough money to continue to stay afloat and to stay as a business. Overall support to the entire UK banking system was worth over £1 trillion to try and stave off the crisis. This was all taxpayers' money that was on the line. This is the US unemployment rate from 1994 to 2016. We see the crisis happens here in 2008. There was this big sharp rise in unemployment, but it peaks at about 10%, then it starts coming back down. So it didn't rise to the giddy heights of over 20% or over 25% as it did in 2000, as it did back in the 1930s. And the reason is we had learned something, which is don't sit back and watch the system fail. Step in and bail out the system. Otherwise, there's going to be mass calamity in terms of lots of unemployment, lots of businesses going bust, and then it will take a long time for the system to recover. So we have government stepping in to intervene. We've tried to fix the system. One thing that's been made more prominent is the Financial Services Compensation Scheme. So this means if you've got a bank account in the UK and the bank fails, the UK government will pay out the amount you've got in that account up to, I think it's £85,000. So if you've got less than £85,000 in your bank account and the bank fails, the government will give you the amount you've got in there up to £85,000. Now, the reason the government do this is to try and stop people panicking. So if they do see a bank in a bit of trouble, they don't rush to get their money out, which makes the panic worse. They realise their money's protected. And if their money's protected, they don't rush to get the money out. So if the money's still able to stay in the banking system, it can still make loans and it can still continue to function until happier times come around. So the FSCS, the Financial Services Compensation Scheme, is there to try and give people confidence in banks so they don't rush to get their money out the way they did with Northern Rock in 2007. Lots of other regulations of the UK banking system. There's the Financial Conduct Authority, which regulates the personnel who run banks, amongst other things, to make sure that they're of sound character. And the Prudential Regulation Authority, amongst other things, tries to make sure banks hold enough money in reserve. So they're not going to let the reserves fall by too much. Otherwise, they could be more at risk. So they've got enough money to set aside so that if difficult times come around, then they've got enough money there to see them through a bad patch. So in conclusion, banks play a really important role. They take money from savers and give it to lenders, and they can invest in lots of different projects, which are ultimately going to be good for the system, good for the world. But it is a risky activity. Banks do run a risk because they're borrowing into long-term projects, and some of them might go sour. And if banks fail, it's not just the bank that suffers, but society as a whole can suffer. So we need effective regulation of the banks, for example, to make sure they've got enough money sitting aside. They don't just put all their money, they don't just put all the depositors' money out straight away to try and maximise their profits in the short term. Make sure they've got enough money set aside so that if difficult times happen, they've got enough to see themselves through a difficult patch. And we don't get into the same situation we had in 2008, where banks across the world all failed because they've got a lack of reserves, and then lots of taxpayers' money put on the line to try and bail them out.